Financials this morning, rebounding a bit with both the KBE and the KRE coming off what was the worst day since the end of May. This, of course, on the heels of earnings from JP Morgan this morning. Goldman Sachs also out with earnings. Wilfred Frost has more on those results. Sort of a mixed bag, I guess, this morning in terms of the reaction, Wolf.
It's David, but better reaction than in the pre-market, at least. The key theme, though, for banks so far in the quarter has been stronger fee income, but weaker net interest income than expected. That's what's weighed on JP Morgan shares so far today. Their net interest margin was a little soft, 2.49%. Citi's yesterday also a little soft, but they were able to reiterate their full-year net interest income guidance, whereas JP Morgan cut theirs by $500 million to $57.5 billion. The new CFO, Jem Piepszak, explaining that would be if there is just one rate cut. It could be worse still if there are more than that. There are also some one-offs in JP Morgan's numbers that flattered the EPS speed, including a lower-than-expected tax rate, a reserve release, and gains from the TradeWeb IPO. Wells Fargo, kind of similar, but a little less pronounced. A beat on the fee income line, a slight miss on the net interest income line. Their provisions did look fine, and so far, no comments of worsening credit quality from any of the banks. Goldman Sachs leading the pack today, in part because it is more tilted to fee income than net interest income. Their beats spread across multiple divisions, especially equity trading, which was in fact up 6% year over year, and also their investing and lending business, albeit that contained their one-off gain from the TradeWeb IPO. Bottom line, exposure to US rates is bad. Exposure to markets, less bad than feared, and that's why the regional index is down, along with JP Morgan, and why Goldman Sachs leads the market higher. Also worth pointing out, Morgan Stanley, they're up a full % ahead of their numbers, which come on Thursday. On the macro environment, Jamie Dimon said, quote, "It's not that bad. Consumer in the United States doing fine. The business sentiment is a little bit worse, mostly because of the trade war. I wouldn't get too pessimistic." Yep, similar kind of theme coming from David Solomon on the Goldman call, which is ongoing. The Wells Fargo call just kicked off.
Yeah, I was going to ask about that call. Well, you know, not a lot about their efforts when it comes to the consumer, broadly speaking, whether it's Marcus or the credit card. Is your expectation that Goldman on the call is going to get a good amount of questioning?
Yeah, the Q&A part is just sort of kicking off as we speak. There was also, in fact, some comment more on the wealth management business. David Solomon was keen to highlight that one of their acquisitions, of course, is just formally closed, and that's an area that they see themselves pushing significantly. I haven't had any questions on Marcus and consumer yet. The other area, David, that I think is of interest is the increasing transparency they're giving on investing and lending. As you well know, the INL business, as it's often referred to, has been what's got them out of jail for much of the last 2 or 3 years when they've seen declines in trading. Analysts never previously paid up for the beat in INL because it was kind of seen as a little bit of a black box. But they are increasing their disclosures there, and I think it's starting to get a slightly better weighting in analysts' minds. And David Solomon talking particularly about the debt side of INL in this most recent quarter, and a lot of the beat did come from there this quarter, and people rewarding it. It's up 2% in the stock.